The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name is Gaurav Sodhi. Joining me today is analyst James Carlo. Welcome, James.
Hello.
Also with us is the very noisy Mickey Mordick. G'day, Mickey.
Thanks, Gaurav. Sorry, that wasn't me. Yeah, I'm sure. Might be Steph in the background there.
Yeah, you're noisy
away.
in general. Not this specific instance, just generally. Very noisy. How you been, Mickey? It's been a while since we've had you in the podcast. Where are you now? You're in the office or you're at home? You're at home, right? No one's in the office.
So we're still observing social distancing. So spending.
Especially in Victoria. The Premier's been getting upset about people going to
really? Okay.
the office in Victoria. Yeah.
I wasn't sure because you guys have a tiny office over there. I thought maybe some of you might be headed back.
Well, it's public transport is the problem, isn't it?
Oh yeah, right. Okay.
Well, there's plenty of public transport, but it's fine. It's fine by me working from home.
No, but I think the Premier doesn't want you going on it. That was my understanding. But anyway.
Well, they seem to be running it, so.
Yeah, well, they don't want people squeezing onto it. Anyway,
they just want a bunch of empty trains.
Yeah,
running.
Essentially, I think that's right. Yeah.
Okay, that makes sense.
Yeah, it does highlight the point that I'm not sure we all know what we're doing during this time. Most specifically governments. I'm not sure anyone has a plan. There was an interview with one of the Chinese medical honchos done on, I want to say New Yorker, but it may have been somewhere else as well. But in any case, they were speaking with an American news outlet, and they were just kind of talking about how successful they've been in curbing the virus and taking all these extra additional plans. And one of the journalists asked him, "Okay, so what happens long term? What's the plan?" And he just paused and he said, "There's no plan. No one has a plan. There's no plan long term.
Just winging it."
Well, we all are a little bit. I mean,
I think that's all you can do. I think that is actually all you can do because we find out more about it all the time, and who knows what the future holds, really.
Well, but gents, we are living through one of the most extraordinary rebounds I have ever seen. I mean, I'm generally very optimistic about stocks and have been generally quite optimistic, but this is extraordinary. The bounce back we've had, the fact that it's been so broad-based, and a lot of stock prices are now back to where they were pre-pandemic. Some of them are even higher. It really begs the question. JC, perhaps you can go first here. Have we done too much too soon? Are stock prices starting to worry you a little bit now? Or are we all right?
Well, I wouldn't. Yeah, I mean, they are starting to worry me, but it's more a function of I mean, talking personally, what I've got invested. So if you invested a lot as the market was falling, then after the rebound, you're going to have a lot more invested now than you did before even the pandemic struck. And so you have to ask yourself whether it's, the market's still a little bit cheaper than it was, but to have more invested now, given the risks, especially when I got a mortgage I can pay off if I sell a stock, then, to me, the balance of risks has shifted. So, I mean, I wouldn't want to call whether the market was expensive. I don't really try to do that short term, and most of the stocks I'm looking at are still pretty well priced. But they're not the giveaway prices that they were, and I've now got way more invested, or I did have way more invested than I had before the pandemic, and certainly more than at the bottom. And so I've been selling some stuff quite heavily, really. I've sold maybe quarter of my portfolio.
Oh wow! Because you've been, I mean, I have to say, everyone's been pessimistic a lot. You, James, have been one of the few voices I've heard who's been quite willing to buy and quite optimistic during the whole thing. Actually, even during the depths of it, you're still trying to urge us to buy stuff. I know you're buying stuff yourself, and Okay, so now you
Well,
get to
unfortunately, I was a bit too optimistic because I
maybe so.
didn't.
Okay.
It means you
Well,
don't get the bottom, doesn't it? So most of the stuff I bought was on the way down, so I can't claim to be too clever. But even so, it's showing a decent profit now, and as
yeah.
I say, it means that my overall portfolio is now way bigger
Mm,
than it was. I mean, as I say, I have this luxury, if you can call it that, of having a mortgage. So my portfolio can sort of flex up and down according. I've got a viable alternative, is what I'm
mm,
trying to say. Paying off my
mm,
mortgage makes me whatever it is percent a year
mm.
in saved interest, and especially when you take the tax into account. Um, so if you don't have that, then you have cash as an alternative, which is harder to flex, as it were. But it would be hard to justify now, I think, having a more invested in shares than you had before we really realized the extent of the pandemic.
Mickey, what about you?
Yeah, well, I agree with James. I think you've got to look at these things in terms of the actual businesses. I think I've tried to avoid thinking about whether the market's overvalued or undervalued because I think that's generally not helpful unless you're considering maybe buying an ETF or something like that. And I think what we're trying to do, we're not looking to buy ETFs. We're looking to try and find individual businesses. So like if you look at the ASX 200 and that's the market, it's mostly some big banks, some miners, property, maybe some telcos. And so you never have to own those stocks. So you're better off just kind of, even if the market is overvalued, um, you're still just better off looking for individual businesses, kind of trying to figure out, are they going to be affected by the virus? Will they make it to the other side? And I think that way you don't get too focused on the macro, and you don't miss the opportunities that can present themselves
Yeah,
when things look really scary.
I agree with that. I think the looking at the market in aggregate is a complete waste of time. I don't even know why so many people do it, especially in Australia. It tells you nothing. The top 10 stocks are what, 60% of the market or something, maybe more. It just makes no sense to base your entire investment decisions on what the aggregate is doing when they're dominated by a handful of companies. So yeah, I
Yeah.
completely agree. But I haven't been, look, I've been surprised by the speed of the turnaround, but I don't think it's been irrational, and I don't think it's been steeped in optimism either. Most fund managers I read about and most analysts who I speak to are still quite pessimistic, and I'd call JCE and myself still unusual in that regard, and that we've both been a bit more positive about the market. You read commentary, and most people are really wary of where the market has gone, and most people are still predicting businesses to be in a lot of trouble later on this year. I think there was a survey done, and something like 90% of fund managers said they are sitting on cash, elevated cash levels, and that they're expecting a pullback. So it's not as though the market is overly enthused at these levels, and that makes me think that, yeah, it makes me a bit more comfortable. So I haven't actually been taking profits. There's stuff disappearing from our buy list. I've been watching our buy list shrink slowly as prices go up and the buying opportunities disappear. But I don't necessarily think we need to go out and sell a lot of things. For me, the opportunity set has changed. The high quality stuff is now probably not as interesting. But I think if you look further down, some things at the pointier end, things like retail, maybe property. I think that auto sector, those things are maybe a bit more interesting for mine.
Scary stuff.
The
I
scary
think
stuff.
the interesting thing is that and I don't want to try to second guess the sentiment, but I think what's happened is that in the teeth of the in at maximum fear, if you like, in when the market bottomed in March,
Hmm.
everyone was just terrified of what was happening, and was sort of selling in response to that fear, essentially. And then everyone sort of sits back with the cash that they've got or whatever,
Yep.
um, and wondering what to do with it, and most investors, institutional investors, don't have these mortgages to flex in and out of, and so they're sitting there saying, right, now I've got all this cash. What do I do with that to make a yield to pay my pensioners or whatever it is? And the answer is there's not much except for shares because they yield that much more, assuming they continue to make some profits. So the cash and bonds aren't making very obvious alternatives. With the bond yield, the 30-year US bond yield is what is it, around 1.5% or something. So I think when people actually sit back and the fear is when everything's calmed down a bit, there's not much alternative to shares, really.
Yeah. I mean, and the government clearly doesn't want people saving. They're doing everything that they can to push interest rates lower, and like all the fiscal stimulus we're talking about, for example, the home buyer grant, or, money now to do home renovations. So I think you can't underestimate the government response to this. And I think they've also shown they're going to do basically whatever it takes to keep people spending money, keep money flowing through the economy. And so whether that solves the underlying real issues, maybe that doesn't matter. Maybe it's just a matter of creating enough money to, devalue the currency and potentially keep people, spending. So not that that's definitely going to happen, but it looks like that's what's taking place all around the world now. So yeah, I think that's right. Like, you haven't got many options in terms of what you do with cash right now.
I think the psychology here is quite important as well. Most people will be looking at the recovery from the lows, and if you do that, it looks really swift and maybe a little bit crazy. But if you look at where we are from the top, I think that actually looks all right. To me, the market actually looks quite rational, and it's behaving the way it ought to be behaving. I still think those scary stocks are still priced quite low for a extended period of losses, and that's probably correct. So if you're going to play in that area, you're taking on additional risk to earn additional return, and that's also what should happen. And I think if anything, those ultra high quality things, stuff like Zero and some of those technology names, they look a little bit overdone to me. That's actually seems to me like they've become the new safe havens, as people, they're not going into banks and other blue chips for their safe havens. They're going into these big new tech stocks, and they
Well,
look
I think people are saying that the cash flows aren't really going to be affected too much.
sure.
And yet we've got lower interest rates to plug into the DCF.
Yeah, that's true.
So
true.
that's
yeah.
And then I mean, so I suppose those two things balance out, and that's why we're back at pre-pandemic levels. But as you say, the more scary stuff, the travel stocks and things like that, still priced at big discounts to where they were.
Or some of them.
Part of that's been affected by capital raisers as well, of course.
Yeah.
Sorry, you say, yeah.
Yeah, some of them, you're right. Some of them are still quite low. So I guess I was thinking about things like that whole car sector, auto sector, is still much cheaper than it was a couple of months ago. But something like Webjet has really shocked me how it's bounced back. The market cap on Webjet is now larger than it was before, which surprises me. I'm surprised.
So before the capital raising, or
Yeah, before the
I mean,
pandemic,
it's not larger than it was in January.
isn't it?
No, I don't think so. But I mean, well, it's raised a lot of money as well. Remember, but the market cap's still a long way down from
Yeah,
January. Yeah,
I wouldn't.
$14.
Yeah, I wouldn't hold the. I wouldn't value the cash at 1-for-1 in that business. That's going to disappear
Where
very
it's
soon.
being spent. Yeah.
Yeah. But yeah, I mean, the recovery has been quite selective as well. I mean, I'm surprised also that the way some sectors have been left behind. I think retail is still looking quite interesting, but even within retail, there are some stocks that have shot up. I think one of the best retailers is Super Cheap Auto, and they've gone bonkers. That share price has gone nuts. And I was hoping we could get a chance to have a look at that, but really it just looks a bit overdone. But there are others that are still looking very, very cheap. So it's a very discriminating market, and that's usually a sign of rationality at work. So it just doesn't seem to me that we're in over bullish, enthusiastic territory where prices are being mispriced wholesalely, and that's probably why I'm still feeling pretty good actually about where we are.
Geez, you're talking me around, Gaurav. I have to file them back.
Well,
No, but I think you're right about it being selective. I think people are desperate for some long-term, cash flows, and so that is rational, isn't it? And so that's why the quality stocks and those with some decent growth prospects, have been are almost back to their pre-pandemic levels. But the market's being very selective.
Now we've been we've been pretty selective as well in expanding our buy list, which has at one point I think I counted more than 30 stocks, which is the largest buy list I've ever seen in my time working at II, and that's starting to whittle down a little bit, but it's still a fairly large number. I think I counted a couple of days ago 16 or 17 stocks, which is still a pretty decent number, and most people would any one time are probably looking for a handful of buys. So they've got decisions to make, our members. And so to help them out, we've put out a special report about the best buys. Now, that report, I think, has already gone out. By the time you're listening to this, it'll probably go out, or if it hasn't gone out yet, it'll go out soon. You'll see it in any case. What we wanted to do now is just to give our own personal tips for what our individual best buys might be. They can be selected from our buy list, but might be interesting also, fellas, to delve off the buy list if you have any ideas that you've been looking at that, for whatever reason, haven't made it to the list yet. So, Mickey, let's begin with you. What's your best buy, and are there things you've been looking at off the buy list that are interesting as well?
Yeah, so there's a few stocks I've looked at off the buy list, but I've gone with a couple that are on the buy list. So the main one for me would be United Overseas Australia, just given that a lot of other companies on the buy list have already run up quite a lot, whereas that's stayed pretty much. It's almost as if the pandemic didn't happen. Really, it's pretty much done nothing the whole time. It's down a bit from the.
Well, it was up into
highs.
the 80s, wasn't it, in February?
Well, yes, yeah, that's true. So I guess it has come
Hasn't
back a bit.
recovered. Yeah, it's come back a lot, but not recovered. Yeah.
Yeah, so and I think that's fair. So United Overseas is the Malaysian property developer, and so commercial property will probably take a hit through this period, although it remains to be seen by how much. Particularly, kind of the hospitality, the hotels that they run, and even the office space. The reason that I like it at this stage is, although it might be a bit of a headwind in the near term, this business has no debt whatsoever. It's got $400 million cash on the balance sheet, and these guys have got a fantastic track record over the last 30 years of buying into these types of conditions. So through the GFC, the Asian financial crisis, for example, they put a lot of cash to work, and that set them up for the next 5, 10, 15-year periods during those kind of distressed periods of time. So so the management looks good, and they own almost 90% of this business. It's like their private investment vehicle, except it's public, and so we can see the track record there, and I just think that these are the conditions that are kind of made for this business. And having $400 million on the balance sheet right now with no debt, I think is a great place to be.
And that's against the market cap of how much, Mickey?
Oh, well, the market cap now is about $1 billion. So
that's a big percentage of the NAV, isn't it? Yeah.
Oh, it's huge. And so, I mean, if you consider the whole thing is trading at about 70% of book value, so you're really not paying
and
much
40%
for the other.
of that book is cash?
It's about 30% because of minority interests and things like that.
Right.
But they've got $400 million that they can actually deploy. But about $300 million is attributable to to us as shareholders. And it's only on 9 times last year's earnings as well. So I think in terms of value for money and in terms of risk and so over a 5 to 10 year horizon here, I think that looks pretty good. So
Yeah. It's definitely the best Malaysian property developer I've ever seen.
that, yeah.
Do you want to mention, is there anything, so you said that nothing else off the list really interests you at the moment? You're not focused on anything else?
Well, there was one other stock, and
Go on,
I did
Mickey.
mention
Don't be
this.
shy.
Well, I did mention it at the Dragon's Den, but it didn't get through. Was Omni Bridgeway.
Oh yeah.
So this was the
the
litigation
litigation funding.
funder, and
We hated it. We hated it. I don't think anyone liked
hated it. Funnily enough, it's actually up since then.
Well,
that's the way.
the government said it was introducing new rules against that
Yeah,
on litigation funding, didn't they? And the stock price went up that day, didn't it? Because I looked, and it was, which is a bit curious. Is there a reason for that? Or
Well,
is
I
that
think
just
this
the
is
market?
something that they've been fighting for a long time. Is getting more licensing and regulation into this industry, and that's to that'll just increase the barriers to entry. Hopefully,
Right.
the reason that it looks interesting now is I didn't get this at the time, or I kind of missed this at the time. Thinking about all the negatives, and it's actually a good point. Sometimes you should stop and think, well, who are the winners going to be out of this, rather than who's not going to lose. But
Lawyers.
just
they'll be the winners.
the amount of litigation that's going to come out of all of this, broken contracts and mass layoffs and everything. These guys are going to be busy for years sorting this sort of stuff out. So that's good for their fun. And but I mean, ultimately, it was a bit of a complicated idea. The accounting's a little bit tricky, and but I think long term as well, that's going to become a more competitive space. Barriers to entry aren't that high really. So, but over the next medium term, it's definitly well placed given coronavirus. But I mean, this doesn't take into
All right,
account
Mickey. This is
price.
not another Dragon's Den for it. Don't try and sneak one through.
Well, the price has gone up now, so
So we were wrong. That's what you're saying, isn't it?
Yeah.
No, well, I mean, it's a different equation at the current price. So
okay.
yeah.
Yeah, no, it always feels bad because Mickey had done so much work on the Dragon's Den. It was a really well presented idea, and the numbers looked quite good. And yeah, we were quite harsh on him. So yes, and the share price went up afterwards. So I don't blame you for bringing that one up.
I don't think we were harsh, but
we were pretty unanimous.
Skeptical, I think, is the.
It's unusual for a Dragon's Den idea to be universally condemned.
Well, but I don't. Yeah, I think I'm not sure that's not my memory of it. I think that we just. I mean, look, I don't quite get it. Is the answer, and I think that's part of your bull case, isn't it, Mickey? Because I think the market doesn't perhaps quite get it. I mean, it's.
I think so.
Yeah.
It's a little bit like it's an unusual business model, and the earnings are so lumpy and inconsistent that you can't plug it into a traditional valuation model and put it on 20 times earnings. You've got to do a bit of work to normalize the earnings and even to kind of guess at what they're going to be. But
it's
also
just. Sorry, carry on. Yeah,
Oh,
I was going to say
go.
it's hard to see the barriers to entry. I think that was our concern, is that competitors come along. They've got a great track record, but that was a track record built when there haven't really been too many competitors, and it's getting harder now. And
that's right. No, that's true. And so there were definitely legitimate reasons that it doesn't feel quite as robust. However, it's got that long-term track record. I mean, going back to the early 2000s of having done this, and they've got a really phenomenal track record over that period. So
it was always I think most of this record was built up as a niche service where there wasn't many competitors. It's now become an alternative asset class in itself, and hedge funds have actually gone out and now hired lawyers on their own books and are funding litigation cases as an entirely separate asset class. So it's actually quite crowded. There's a lot of competition building in that area. I also think it's a really grubby space where it doesn't really serve. It doesn't solve pressing problem, and
Oh, people need to be able to bring cases.
yes, they
I mean,
do.
people
But when
need
you
to be
get
able to get justice.
no, that's true. Yes, no, that's correct. I guess what I'm saying is that there's a risk of because the historical returns are quite high and the barriers to entry are quite low. I think the industry risks over servicing, and
Yeah,
that
no,
invites
no doubt. Yeah.
a lot of regulatory lockdowns, and you kind of expect that. I don't think it can function the same way it has in the past. There has to be more controls about what it can and can't do. There's just a lot of and the accounting was a mess. I must say the numbers were really hard to comprehend. Um, I didn't. I must admit I didn't quite get it either. But I think that is part of the bull case.
Yeah. Well, no, that's all good. We'll just have to
Yeah.
wait another 50% to upgrade it, and then
Yeah.
After it doubles, we'll have a look at it again.
Yeah.
No, just kidding.
So for me, the stock that I wanted to bring up was South 32. It's one that I think it's always running below the radar because it's not a top tier miner, even though it got cast off from a top tier miner. People don't think about it. It's a hodgepodge collection of strange assets, things like manganese and alumina, a little bit of nickel, a little bit of coal. It's just as a hodgepodge of assets that's been spun off, and it doesn't really get a lot of attention. What it does have is all these assets. They're not tier one grand mining assets, but they are very profitable. They're relatively low cost, and the business is just really well managed. They're sitting on a heck of a lot of net cash. They got a great track record over the years. I feel as though we know this business really well, and it's just cheap. It's sort of for me, it should be trading at a premium, a small premium to asset value, and it's trading at the moment at a huge discount because commodity prices have, especially these quite specific commodities that South 32 deals with, have been hammered by the pandemic and also by cyclicality. So I think this is a really interesting opportunity. Unfortunately, it's actually jumped quite a bit since it's up 5% today for some reason, and ideally you want to get this around the $2 mark. I think that makes a really good buying, but I mean, even now, it's not a crazy idea. There's still a very healthy discount and margin of safety baked into today's share price. So I think it's a really good idea.
Is the asset value at risk of write downs with the commodity prices so much lower?
Yeah, no, look, I don't think so because on the cost curve, they're actually still quite low, and the return on assets is still reasonable for almost all their commodity groups. Now they're going to get out of some of their lower performing mines. They're on the market for sale, and I value those things at zero already. And they've got a couple of development assets, two really good-looking new mines that are on the books at acquisition costs, but I think which are worth far more. Obviously, as those things are developed. One of them in particular, they've got this mine called Hermosa. Just looking at this thing, this looks like a copycat of Cannington. I think this could be a multi-billion-dollar mine in itself, but it requires probably 4 years of development expenditure. So, look, you probably have to be patient to realize full value out of this. But the thing with miners is you just got to buy them when they look very yucky, and it's really hard to do. And this doesn't look great at the moment
I
on
find
any
it
metric.
impossible.
Yeah, but this is the time to do it. This is
Well,
the way we made money from it last time as well.
it's
I think
it's
the same
also
thing
the
stands.
capital allocation, right? Like that's the tricky because when you get all the cash and then you've got to redeploy that. Hopefully, you're doing.
Yeah.
That's the hard part, I guess.
Well, that's the good story about this business. It's superbly managed. I think this is one of the best managed miners in the world, and they were doing good capital allocation well before the big boys were doing it. So I'm very comfortable with management here. I think it's a really interesting idea, and that was one for me. The one off the buy list that I recently bought myself, another Dragon's Den reject, I have to say. Actually, I think it's AMA Group. I wrote this up as an ideas lab after it got thrown out. I think among fits of laughter and outrage from the Dragon's Den, but it wasn't popular at all. JG in particular, I think, was really scathing of this idea. I think Graham was the only one who thought it was interesting, and the rest of you guys hated it. And then it promptly halved in price. So you guys are probably right. But um, it's carrying the reason it's not on the buy list. It is carrying enormous levels of debt, and I think there is genuine balance sheet risk with this business. And we're not going to recommend a company that has such an exposed balance sheet, especially at a time where the revenue is going to be falling for the next little while. But the reason I think it's interesting is if they can come to the market and raise some capital, this is actually a relatively robust business. It absolutely dominates its market. So AMA is it's a collection of panel beating shops, and they have I think it's like 30% of the market for panel beating. And you might think that's a lousy business, but what they've done is that they've really cleverly invested in processes and in technology to turn cars around really fast. So I think they do about 80% of all their repairs within 8 hours. And what that does is it turns the business into a bit of a bit of a I think of it like a manufacturer with a fixed cost asset base that it turns over cars really, really quickly. The returns on capital are quite good over time for this business. It's an owner manager running it. And they've had a really good track record. I think it's quite an interesting idea for a rebound, but it is really hairy. And this is not one for risk averse investors, and it's one for a very low capital allocation limit. I'm really in there hoping they raise capital at some point, fix up their balance sheet, at which point we'd look at it again as an II idea. But yeah, it's hairy, but it's interesting. And since I might just throw one more in there since I've got the mic. Another another Dragon's Den reject was Pacific Smiles, which actually I think from memory, most people didn't mind the idea, but it was very illiquid and small, and we had trouble with those risks. Now it's still illiquid and it's still small, but again, for this kind of segment, I think it's a really cracking idea. If you're interested more about Pacific Smiles, I wrote an ideas lab on it, so you can look that up. The stock code is PSQ. JC, what do you have?
Well, I've struggled with this a bit, I've got to say, because, like I say, I mean, I've sort of been selling a little bit. I mean, not that I don't, there are stocks that I'm very happy to hold, but I was holding too much of them, I suppose. So, finding stuff to buy has been difficult. So the way I looked at it is, if I had a completely blank slate, zero portfolio, where would I be looking to make a start?
Oh, I know where this is going.
Well, the first two stocks on my list
Yep.
would be Omni Bridgeway and AMA Group. No, I'm afraid. But Mickey has taught me around to UOS. Actually, I mean, I hold UOS.
I
Yeah,
also hold UOS and
it is.
Omni Bridgeway.
Yeah,
Yeah.
I think I actually laughed when the stock first came up, and I was scathing of the idea, but then when it got explained, yeah, it got through the dragons, and I think unanimously at the end.
Yeah, US. I mean, it's a great stock, and Mickey's explained it pretty well. And
Yeah.
that would be, I think, probably number 3 on my list.
Wow. Okay.
So number 1.
Oh, what about number 2? Let's do the top 3 here, James. Don't keep
Yeah,
countdown.
we're getting to it. Just patience. So
Okay.
number 1 on the list would be
Right.
Audinate,
Of course.
which I think is a great opportunity.
Yeah,
Still,
yeah,
I mean, it
agreed.
was an even better opportunity at 250 or whatever it got to. But we're still at 650. It's my biggest holding. And I think it's very attractive at current levels. The interesting thing with Audinate is that it seems the market seems to be pricing it as though there's a direct risk to it from a lack of because it makes money by getting its chips into
Audio equipment.
audio equipment that goes into big stadiums and conference centers and stuff like that. So, but I think what the market's not really taking account of is that the value in Audinate is very much in the future. At the moment the penetration of its digital AV technology is relatively low, and what we need is for conferences and stadiums to be full in 5-10 years time, 20 years time. And I'm pretty confident they will be. And so for me, the story really hasn't changed a great deal. The company raised capital last year really to accelerate its growth plans, and has sort of scaled back those growth plans now, which is slightly a bit of a regret actually to me. I mean, I suppose it wouldn't have wanted to raise money again
Yeah.
to maintain that. So obviously revenues are going to be a bit lower than anticipated. So it's not going to be making the cash flow. You know, it'll be losing cash.
That was such a good time to raise money as well. I remember people were questioning Audinate for doing that. Everyone going, "Oh, you're cash flow positive," and so it's good foresight, I guess.
Well, it was, and you know they want to make the most of their market dominance, and they want to roll out a lot of products and bring forward those cash flows, bring them closer, so to increase the value. But it raised money. It wasn't at $7, and the price is now $6.50. So I wouldn't be surprised if it raised money again, just so that it can restart those growth plans. Rather than holding the money to sort of as protection. But I wouldn't be sad to see it do that at these levels. I mean, I think it would have been very dilutive at 250 or something. But so I think that's a great opportunity. Number 2 on my list would be Altium, funnily enough,
I knew it. Yes.
which is. Well, it's a bit. So our buy price is $30, and it's currently 37, so it's a bit higher than that. I mean, you guys sort of when it went to the Dragon's Den initially, it was about this level, and you guys sort of pushed back against it and thought it was a bit pricey. And good thing too, because remember we got to upgrade it at a much lower price, and hopefully members were able to buy it at that price. If I had a blank slate, I would still, I think, have it second on my list to buy right now. But look, I'm a bit more loose with my valuations, I suppose, and with these great businesses with a long runway, I'm sort of prepared to push the boat out a little bit. And Altium sort of fits that mold. But I say that having sold some shares in it over the past week or so, just to bring my, because I'd loaded up at lower prices. And it's up significantly. It bottomed at about $23, so at 37 or so, there's my holding was getting a bit uncomfortable. So that's the story with that.
Yeah, it's also, I think it's my second largest holding as well, and kudos on the work everyone's done. I think we've all had a go at having a good look at Audinate, and I think it's a cracking idea as well. Happy to see it on the buy list. Anything off the buy list? We've been focused on trimming, have you, James?
Well, I don't know. I tend most of my stocks are on the buy list.
Yeah, they are, aren't they? Yeah.
or at least they're on, or at least we cover them. I mean, I've got Sydney Airport, but I wouldn't really be buying that now.
I reckon, JC, you would probably have a perfect record of Dragon's Den pitches, right? I can't recall one that you've put up that has been rejected.
Well, you're not back out to.
But we got there in the end. We got there in the end.
We got there in the end.
Yeah.
But,
so what we've figured out from this podcast,
and you slowed me down a lot on Webjet as well, incidentally, which was a very good thing.
Yeah, that's true. Actually, we threw. That's right. Yeah, no, scratch that. Yeah, Webjet went straight out, didn't it? Yeah.
Well, no, you were okay with Webjet, but it was falling so rapidly. It was just sort of we were watching it go down as I was doing the work, really. But yeah.
Mickey, did you have something to say?
Oh no. Well, I mean, no. I was just saying the good thing about the Dragon's Den is if the idea doesn't work out, then everyone saved you from it. If it does work out, you can say, "See, I told you."
It's great. Yeah, I still have it. PWR for me got rejected from the Dragon's Den, and to this day I rub it in every time I get, and I conveniently forget all those huge number of Dragon's Dens that are still way below the price I bought them to.
The Power Holdings that's not up, is it? Since
it's only up 2.5 times, JC.
Since the Dragon's Den, really?
Yeah.
Jeez, I was the biggest, strongest voice against that as well. I think, if I remember rightly.
The problem is you actually made some sense, so I didn't buy it myself, which is the worst of it.
Yeah, sometimes if you make sense, too
Yeah,
much sense, it can, it's those sensible arguments that really
that's
get you
right. They're the
because
ones that kill you.
they're believable.
I was reading a fund manager article the other day. It was an article written about this fund manager and the way that they do it, which I thought was really interesting. When they pitch an idea for the first 5 minutes, everyone has to say something positive about it.
Oh,
And so to encourage everyone to think about the good parts of the idea,
hmm.
because the first instinct is, oh, what could go wrong, and which I thought was an interesting approach. And then these guys, they don't even care about valuation. They're just talking about um, what could go right.
That's interesting because for us, it's the opposite. For us, the whole Dragon's Den process, the onus is on the idea generator to make the case for it, and our job is really to see how we can tear it down. So it's always a little bit adversarial, and I think that's right. That's the way it should be. I mean, you got to fight to get onto the buy list, and I think that's the right thing. I find that weird that everyone has to
But
say
there's
something
always
bad about stock.
arguments against, isn't there? I mean, look, I can see both sides. You can always make good arguments against things if
Well,
they're
you just want to get good stocks on the buy list, I guess. And I guess if you're not good at arguing your case,
Yeah,
good,
that's true. Yeah.
you know. Um,
Yeah, it does introduce a new skill in investing, which it's not really something we screen for or train for. But we look for people who can analyze stocks, but and who think in the right way. But another part of the analyst's job is actually to present ideas, and yeah, it is a bit of a skill to get
Well,
an
that's
idea
part of
right.
our job with
Yeah.
members as well. We present our ideas to
Oh
members. So
yes, no, for
if
us,
you can
yes.
do that in an article, then you probably should be able to do
No,
it
you're right.
to
Yeah, that's
analysts
true.
in the Dragons Den.
Yeah, that's true. That's true. Yeah. But if you're an analyst working at a more traditional fund manager, it's probably not something you get trained or tested on, and it's a really important part of the job.
But yeah, I think the problem with the adversarial sort of approach is that it polarizes opinion, doesn't it? That's very dangerous, isn't it? In the share market. You need to always be able to, as the analyst presenting an idea, you need to be presenting in a very balanced way the upsides and the downsides.
Hmm.
And so, if you want to get your idea through, as it were, then you might be encouraged to sort of push the upsides more than otherwise, and I think that starts to be a bit dangerous, doesn't it?
Yeah.
mm,
Yeah.
yeah.
We have strayed way off the reservation here, James. We're supposed to be talking
Bring us
about.
back in, Gordon.
Yeah, all right. Let's finish this off. We're supposed to be. Let's do this very fast, then, James. We had a quick segment on some of these travel stocks that you've been looking at, and that have jumped enormously over the last 2 weeks or so. Let's have a think about Flight Centre and Webjet. We don't need to go into the details too much because we've done articles and podcasts on those in the past. But just talk to us about where the price is now. Are these still worthy of holding? Forget about. I don't think anyone's at II is really talking about buying them now. But are they still worthy of holding? And are these still long-term investment ideas, or do you think the case is now permanently changed?
Well,
Because Flight
Webjet,
Centre now, for example, is a very different business to what it was
yeah,
3 months ago.
yeah. Well, that's right, and that's why we've taken our price guide off it, and we've got a hold. We, I think Flight Centre. I mean, it has a strong balance sheet, especially after the capital raising, but it has one leg, its biggest leg of the business, the retail business is permanently compromised. I think I think it possibly was already. We weren't ascribing too much value to that before the pandemic, anyway. But now they closed half their stores or something. I think that's we certainly aren't ascribing much value to it now. So
Mm.
it really comes down to the corporate business,
Yep.
which is very attractive. But if you put all the value onto that, then then you're valuing it pretty highly at current prices.
Mm.
P of 20 odd, bit more maybe. So
That's fine. 20 is the
um,
new 10, isn't it?
yeah, well, maybe, but there are risks, aren't there? And
Mm.
at the moment, so I think Flight Centre, is more of a problem. Webjet, we're only 10% or so above the buy price. I should caveat all of this by saying it's still one of my largest holdings, but I have been selling some because I bought some much cheaper, and so as I've been saying, it's got to be too big a holding, as it were. So, but so it's with a blank sheet of paper, it's still not far from being where I would, maybe I'd have it fourth on my list if I was going with a blank sheet of paper sort of thing. So it's not that far away from being a buy. I think it's a very comfortable hold. I mean, there are certainly risks, and that's why it's speculative. But Webjet has I think, a more interesting long-term outlook with its web beds business, the bed bank, which actually could benefit from technology. It could be, part of the disruption of that industry in future, and so you're to an extent making a bet on that. And so, so there's a longer term growth story in a way that I think Flight Centre perhaps doesn't quite have.
Yeah, there was. I'm really pleased we had such a long and hard look at Webjet, because I learned something really important, and that was to do with the negative working capital situation. And I always viewed that, and I think most of us viewed that as a positive. It never really occurred to me what happens in a business with negative working capital once revenue starts to fall.
Well, I
And
don't think we'd ever really
I've never seen it
previously
before, right? Yeah,
seen companies just lose all their revenue overnight.
yeah.
I mean, it's quite extraordinary, isn't it? So, um, unfortunately, well, it's a very good thing we looked at it for a long time, because as we did, the price halved or something. So,
Mm.
I mean, it was going down and down. Unfortunately, I got to it a couple of hours too early before the capital raising. But there you go.
So JC as well. One question I had was, given it looks like there was two strategies, around kind of raising capital, and looks like some of the companies tried to get out of the blocks early and just get the capital raising away, and whereas maybe some might have been better off actually waiting it out and kind of hunkering down. Do you reckon Webjet raised capital at the right time, and they've raised enough money to actually get through to the other
Yeah,
side?
I think they had to. I think their banks were basically telling them, they had a facility, but I think that it had they were going to breach the EBITDA covenants, and so I think that the banks were able to tell them. The banks told them, "We want you to raise capital." That's my assumption. So I think they probably had a little choice. Uh, and I suppose with hindsight, you say, why do they have any debt at all? But it's easy to say that now.
Mm.
Whether they've raised enough, I think they have, but that's partly why it's largely why it's speculative. The covenants have been waived. EBITDA covenants have been waived for June and December testing dates this year, but it's still there for June next year, June 21, based on the previous, I think, 4 months trading. So they need to be making meaningful EBITDA by the second quarter of next year, the June quarter. And that depends on people getting back to traveling and taking flights and booking hotels. I mean, a large portion of the web beds business is in Europe, and it looks to me, I mean, I think I read earlier today, Italian hotel bookings, I think, or inquiries, maybe it is, for early 2021 are back to where they were pre-pandemic.
Wow.
So, I think that the hotels, at least, the bigger risk is possibly the flights, because, when our borders open up again is anyone's guess at the moment. It depends on so many things.
Mm.
But I think I'm happy to make those bets at around the $4 mark or cheaper, and I'm happy to hold it at current prices.
Mm. Nice one. And as you say, Flight Centre is a different business now. I'm surprised. Surely now we'll see a more informative breakout of their corporate business, because we've always sort of talked about that corporate business as being a very high quality and quite substantial, but they've never really been willing to break the numbers out to let everyone have a look at just how large and high quality it might be. I think we might see that soon. They're going to have to do
Yeah.
it, I think, to get to keep people interested in that stock. All right, we better rule it off there. Unless Mickey, you have anything else to add?
No, it's been a pleasure. Thanks,
Okay.
Gaurav.
All right, Mickey. Thanks for joining us. JC, thanks again for your time.
Pleasure here also.
All right, and for everyone else, thank you for listening.